Welcome to this webinar on managing flows and liquidity in restricted markets. I am Marielle Barkley, the editor of this award-winning Global Treasury Leaders Program, which is organized by The Economist and sponsored by Deutsche Bank. The program's objective is to share thought leadership and to connect treasurers around the world. And we do this through a series of activities every year, which include summits. We're preparing the APAC one coming up in November, but we have in different regions. We have webinars like this one you are joining today, and an online community where we host this content. The community is open to corporates only, and this allows treasurers from all over the world to connect and exchange ideas on any topic of their interest. It is totally free, and I am now going to send you a link via the chat facility so that you can join if you would like to. Just remember, when you join, to choose the Global Treasury Leaders Network because you will be asked what groups you want to join, and you feel free to join as many as you like, but if you want to join this community, you need to remember Global Treasury Leaders Network. So we're sending you the link, but going back to this webinar, the idea is to make this session as interactive as possible. So please ask as many questions as you like using the questions tab on the right-hand side of your screen. Please send them to us as soon as you think of them, otherwise you will forget, and we will bring them up when appropriate. Without further ado, please let me introduce this webinar's chair, Damien Glendinning, who is an independent treasury expert, former treasurer at Lenovo, and currently chairman of the advisory board at Complex Countries, and often chaired as at Eurofinance events. So with that, Damien will now introduce our speakers and the topic. Damien, over to you.
Okay, thank you very much, Marielle, and thank you to everybody who's calling in, and good morning or good afternoon, as the case may be, depending on where you are. And a special hello to all my friends in Singapore. I'll ask Andrea, Amit, and David to introduce themselves in a minute. I find that avoids me offending people by saying the wrong thing. But just a couple of words about what we're going to talk about today and how we're going to go about things. Clearly, there's a lot going on in the world, and there's a lot of areas where risk is perceived to be increasing. I say perceived to be increasing because obviously the risk has always been there, but clearly there is a great deal of turmoil taking place. So I think the conclusion, and this is very much the point of this webinar, is that this increases the importance of good risk management techniques of making sure that you are not in the situation where somebody invades their neighbor and then you're suddenly scrambling around saying, well, how much cash do I have? What do I need to do? And how do I manage all of this? So we'll go through that. And in particular, this is all of the issues of FX controls, track cash, and so on have been issues for a very long time. But I think this is a very good reminder that it's important to get on top of these and go around. And we'll get a lot of input from both Andrea and Amit in terms of what they're doing operationally. And I think when we get to Deutsche Bank and David, there's some very interesting innovations coming out. So looking forward to hearing about them. Just two final words. The first is most of the people, obviously Amit and David are both based in Singapore. So they will have a natural tendency to look at the Asia Pacific region. But that doesn't mean to say that we're limited to Asia Pacific, especially as Amit is also responsible for Latin America. And Andrea has a global responsibility. And I think it's fair to say, Amit, that you used to think Asia Pacific was difficult and complicated when it came to exchange controls and so on. But now you're beginning to think it's actually easy and very user-friendly. But we could get back to that later. The final thing is that obviously there is one elephant in the room, which is creating issues and risk, and that is sanctions. We will not specifically talk about sanctions because obviously everybody has a key objective, which is complying with all the rules and regulations. However, when it comes to sanctions, that can be quite difficult, and certainly there is very limited upside to discussing these things publicly. So if people really want to talk about that, then please feel free to ask questions, but also please understand that this can be a very, very sensitive topic, and it's not that people don't want to discuss it, it's just that you have to be very careful about what you say. So with that, Andrea, would you care to introduce yourself and explain where you are and what you're doing?
Thank you, Damien. Good morning, good afternoon to everyone on the call. First of all, I work for SITA, so I am the group treasurer of SITA. SITA is a leader in providing IT services and communication to the air transport industry. I am based in Geneva, and as you said, I am in charge of the whole world, because Treasury is a centralized organization, so we oversee the whole world. SITA is present in around 200 countries, so this means that we have quite a worldwide exposure in terms of X management, in terms of cash flow monitoring, and all the other Treasury activities. We are present in more than 1,000 airports around the world. We have 2,500 customers. And as mentioned earlier, we provide a service to the airport transport industry. This is our mission. So I'll hand it over back to you, Damien.
Thank you. And that raises some interesting questions we'll come back to. But Amit, would you care to introduce yourself and GE Healthcare?
Sure. Hi, everyone. Glad to be here today. I am Amit Grover. I'm a Regional Treasury Director, Intercontinental. For GE Healthcare. Intercontinental region within GE Healthcare represents emerging market cluster, includes APAC and LATAM. Again, it's a very unique combination, consists of two challenging regions. But coming to GE Healthcare, I think it's a US medtech MNC. It's recently got spun off from GE. Over the course of last 1 year or so, we have been extensively working on separating out GE Healthcare from GE and building its own treasury organization. Coming out of a big conglomerate like GE, it's never easy, but something which comes with good with its advantages as well. We have been able to leverage best practices and the outstanding work which GE Treasury team has been able to do over the years. And although I'm very new to this particular role, but I've been part of GE Corporate Treasury team prior to this, and I've been extensively working on creating creating strategic and transformational liquidity or cash management structures across the region, which is really helping me in my current role as well as I plan to build up GE Healthcare Treasury organization in the region. So that's a brief about me.
Okay, and that's fascinating, and it's an interesting mixture, and I'm glad I'm not in your position of having to fly between South America and Singapore. It's not easy.
Absolutely not.
Yeah, David, I think everybody knows Deutsche Bank, but would you care to expand on what you're doing in there and the interest here for you?
Sure, thanks, Damien. So, as already said, based in Singapore, my remit and my team's remits across the Asia Pacific region. And what the team does is quite unique in terms of connecting various processes across cash, FX, and liquidity together. The team's called Workflow Solutions, but it's essentially providing clients with processes to deliver their treasury goals. So it could be centralization of liquidity, which is what this conversation is about here. How do you bring digitalization to deliver an efficiency against that treasury objective, which in this case, centralization of liquidity. So looking forward to the discussion, and back to you, Damien.
Okay, so thank you. And if I could just pick up on that, and at the risk of stating the obvious, we all want to centralize cash for a whole bunch of reasons in terms of efficient cash management, but also I think it's fair to say that that is a big risk mitigant as well, is if you have the cash in the center and not in a country which may start imposing controls, then you're in a better position from the risk management point of view. Is that a fair statement? We all agree with that. Okay, within that, Andrea, how do you go about this? Because unless I'm mistaken, your business means that you are inevitably onshore and providing onshore services.
Yeah, of course. So for for a multinational company like us, it's important to have an automated process to handle the payment. So we have various cash pooling in place. So we centralize the cash as much as possible. But as you mentioned, we have to differentiate region by region and country by country. So on one side, we have to be extremely centralized. On the other side, we need to be very careful of the different legislations across the world. So we have to comply with all the legislations in the countries where we are all over the world. So this implies that some countries cannot be included in the cash pooling and they have to be treated separately.
So which are the countries that are not in the cash pool and which one, and how do you handle them? And again, if we can focus on Asia, it's not limited to Asia.
Yeah, of course, yeah. One of them, for example, is India, which is subject to strict regulation in the country. So it has is not part of our cash pooling, and therefore we have to handle it very carefully. So what we do there is basically we we have put in place a way to repatriate the cash once a year, which is working through dividend payments. The issue is that these operations takes place once a year. So for the rest of the year, basically we are exposed to the volatility of the Indian rupee versus the dollar, which is our reference currency. And therefore we have to hedge these exposure. At the same time, the fact that we put in place these dividends implies a lot of documentation preparation which is needed to explain to the Central Bank of India the reason behind the extraction of cash, the board resolutions that we have to put in place, the financial statements have to be audited. So there is only a small window, only a small window during the year where we can repatriate cash. And when we process, so we have to repatriate the amount of cash that we believe is the right one. In order to understand what is the right one, we need to rely on the cash flow forecast that we get from our regions in the world. And that's why it is, if you want, every opportunity, every risk also implies a lot of opportunities. In this case, the opportunity is that we need to have a very close interlock with our regional people in order to have a reliable cash flow forecast, and that's what we do.
But I hope you're not going to say you have a problem getting accurate cash forecasts, because I can't imagine
well, in general terms, no, yes, in general terms, Damien, absolutely. That's, I think, it's an issue that all the treasurers have. But again, for some specific countries, and one of them is India, the interlocks with the region are getting more and more closer, and we dig into the cash flow forecast that we receive from them. There are a lot of consideration that we have to take into account. So if you want, this is a good opportunity for Treasury to show its the value add support that we can give, and on the same time try to, we are educating a little bit the regions who do not have a treasury experience to understand what are the consequences of leaving our cash locally.
Okay, and we'll come back to that, but one question, and appreciate your input on this, and that will be a good segue into talking to Amit. In my experience, it's much easier to extract cash if you're talking about goods imports. Traditionally, most countries with exchange controls will allow for goods to be paid for, especially essential ones. It starts to become a lot more complicated when you're talking about services. Would you agree with that statement? And
absolutely. Absolutely, and we provide services, so we are really one of the companies on heavy document preparation, as I mentioned earlier, to explain the services that we provide and the reason why we want to extract the cash.
And do you invoice the services in local currency, or are you allowed to use foreign currency?
No, we do it in local currency. The second important aspect that I mentioned earlier in the call is hedge during the year, the local currency. And for this one, we have onshore and offshore also hedging processes in place. Again, it's another opportunity for us to explore new ways to hedge, because in this case, we are saying we have an exposure that lasts 1 year. And therefore, our considerations in terms of hedging are maybe different from other currencies.
And it's a good opportunity to get into some philosophical debates about the cost of hedging, and we'll come back to that in a minute. So, Amit, how about yourself? And again, unless I'm mistaken, GE Healthcare is a mixture of goods and services, right? So how do you manage and how does this work?
So I think I feel that this is a very powerful tool, especially to be used in some of these difficult markets to optimize your working capital. It's a very important process, especially for our kind of model, as you said, right, where your import payment is actually a significant part of the overall onshore revenue. So if you really focus on that and really optimize that import payment process and link it back to your collection cycle, you can optimize the cash generation cycle or cash which needs to be kept in these countries. And we have been focusing immensely on that. We have been looking at, and the import process is not easy to be optimized. It's very much manual, cumbersome, requires much more documentation and many more checkpoints and touch points. So all of that, I think we are looking at it from lean perspective, trying to optimize it to the extent possible, and which in turn helps us to optimize cash in the country.
And it's painful and onerous, but not optional, right? So you have to do it. And
Absolutely.
Does this lead to issues with the business? Because often, the business doesn't want to put the resources into doing this. So how do you, at the end of the day, it's resource intensive. How do you manage to get the budgets to do this?
I think good part is that GE and GE Healthcare both are focusing very much on lean. So any process improvement like this is something which is a very important focus from the company perspective. And company top manage, again, it's a top-down approach which has to be taken in these kind of initiatives. And if you are getting the backup from the top management for in process improvements and really improving those ground processes, and I think that's something which is very welcomed in GE and GE Healthcare, and it is something which is, again, we have been focusing immensely from our side.
So thanks, and again, this will be a segue into David, but before we move to him, so you and Andrea have both mentioned India, which I think we would all agree is a challenge. By the way, it's a lot better than it used to be. So I can remember a time when it was virtually impossible to get cash out of India, but you still got a lot of bureaucracy and paperwork. Are there any other jurisdictions, especially in the Asia-Pacific region, which cause big issues from this point of view? So Amit.
Yeah, sorry. So apart from India, I think there are other jurisdictions which are not part of our regional structures, are actually Vietnam and Philippines and Korea. These are the 2-3 more additional markets which we don't have it as of now. We have created very robust and sustainable liquidity structures across the region, which connect seamlessly with the global structures, but of course, with the exception of these 3 to 4 markets. And the challenges are pretty much the same. So if you look at India and Vietnam, I would categorize them in the same bucket. To going back to Andrea's point, I think the first and foremost solution which we look at from our side is the permanent extraction, which is the dividend solution on an annualized basis. It's challenge there is you can do it. You can't do it as frequent as loan. It's something which can be used for your periodic cash extractions, but you can't use it as a loan or a daily working capital tool management for those countries. So I think apart from apart from that, I think the other challenge which you face in these permanent extraction is that local teams sometimes become conservative as to how much cash you need to hold in these countries, and you always have to go back and explain them in terms of how important it is for the company. There's always a to and fro. But I personally feel having good funding solutions in these countries would really help you to have that conversation with the local leadership. That provides that extra comfort to those to the local teams in terms of maximizing the extraction amounts. And this is something which we have worked very well for us. We have taken in few countries, we have taken a phased approach where we have actually created the funding solutions first and then went about extraction thereafter. And I personally feel that funding solutions is equally important, if not more, as compared to the extraction solutions in these countries.
Well, that's fascinating. We'll come back to that because that is certainly a solution. It brings with it some other potential issues, I believe. So let's come back to that in a minute. But let's first go to David, because David, I believe you've got some interesting solutions to some of these issues. So maybe you'd like to give us your perspective and then talk about some of the solutions.
Sure. So, the group picked up on friction. There's a ton of friction across the Asia restricted markets, and India is a good example where you've got the permanent extraction, which is delivered via dividend, but the interco loan facility is not available in the India market. So how do you drive liquidity faster? And it's trade underlying. And as Andrea pointed out, I think everyone's in agreement, India until recently, it was very heavy docs requirements and it was paper-based. What we're fortunate about, and some people on the call will be familiar with, is the customs database that the government set up that allows banks to pull in data digitally for product that's been delivered. And now this is on the good side. That allows banks to create processes such as Deutsche Bank to digitalize the documentation, and then we can start to create rules to drive liquidity. So if you can imagine a scenario where you have a rule around how much liquidity you want remaining in the market, and as long as you've got valid underlying, you can then make those payments, those settlements. So you can start to digitalize the process by saying sufficient liquidity, tap into the government database to see which customs documents are cleared, and then that drives the early settlement of invoices. The same kind of process can be delivered in other markets like Korea as well, based on trade underlying. It sounds like, Damien, you might talk about interco loans later, so maybe I can pick up on that in a bit more detail, but in essence, you can use those same mechanic. You can use the mechanic in other markets of interco loans, but you again need to digitalize those drawdown events, and that's beginning to become available. So I find APAC, part of it being driven by COVID, there's been a significant enhancement with the ability for regulators to accept digital documentation. That's either from a government database, as in the example of India, or where the bank is able to deliver information in a digital format with spot checks around valid underlyings via PDFs or physical documents. So I think the friction is still there, but it's certainly got a lot easier. And then when you layer that technology on top with rules, you can start to automate processes to hit those treasury objectives.
You're right. We'll come back to intercompany loans actually very quickly. But before we get there, if I can pick up on something you said, which I think is very important, and that's technology. Because would you think it's fair to say that governments in Asia tend to be more progressive in the use of technology than in other places?
Yeah, I certainly, I mean, if you look at the retail space, that's really just, ahead of everywhere else, and it's driven the global trends in a number of payment areas. I would say many other markets don't have the level of documentation and regulatory obligations that the Asia Pacific markets have. I would say there's been two markets that have driven what good looks like and the move to digitalization of underlying, and those have been India and China. And then I would say that COVID has driven a proliferation of that across the other markets as well, because, you know, obviously everyone talks about COVID a lot still, but certainly in the banking industry, and I'm sure corporate clients suffered the same, it was very hard to do business in those early days because of the requirement to have wet ink everywhere. So that has been a catalyst to digitalize processes further.
Okay, but you
That's
make
a
a fair
valid.
point. Go.
I
Sorry.
mean, that's a very valid point. I think we can use this forum also to discuss the requirement from the treasurers to get, you know, the document electronically signed instead of wet ink, as you mentioned. So during the COVID, all the banks, of course, were forced to accept, you know, the electronic documents. What we see, or what I see now, is that the banks try to move back to hold the good old times, and they don't only ask to get wet ink documents, but sometimes our signature doesn't exactly match with what they have in their documents, so they have to sign it twice. So we continue to push back, but it would be good if also, you know, the banks all align themselves accepting, you know, the digital signature of our documents.
David, as a banker, do you have how do you answer that?
Well, so I can just answer on behalf of where Deutsche's direction of travel is, and it's to digitalization of the documents and the underlying. And certainly in my area of business, and what I look to deliver for corporates is automation of front to back. So anything that involves wet ink is a step back in terms of what we're trying to do as a bank, and improving and helping clients transform their treasury.
Okay, well, you couldn't say anything else, but clearly, I think we would all agree that once you've made the step forward, it's very hard to come back, although people will try. But I was going to say
think,
also,
Damien,
sure.
if you let me step in, here we are talking about mainly risk management, but the digitalization is, for me, another elephant in the room. The bank account management, the electronic bank account management, is becoming more and more required by all the treasurers. So when we talk about documentation, because documentation is behind all these heavy cash repatriation processes. So documentation should be facilitated using electronic bank account management. From my point of view, I have not seen significant improvements by the banks in accepting, okay, these, you know, a way to handle this documentation in an automatic way. To me, that's an area where we have to work together with the banks to find a standard way to share documents, and also, you know, how to sign them, how to keep all our signatories updated all the time. Because the bigger we are, the more complex the world becomes stringent, you know, to adapt to all these individual legislations across the world. Back to you, Damien.
Thank you, and I fully agree, and I think everybody will agree. But also, if we're not careful, this will become a discussion about KYC. And I think that's a separate webinar. So let's go back to intercompany loans, because David mentioned them, and of course, dividends is the permanent extraction, but it's by no means the only tool in the toolbox. So how about intercompany loans, and how do you use them?
No, I think intercompany loan is a primary tool which we explore in each of these markets. If it is feasible, of course, it's not that straightforward. You can't apply one solution fit all kind of a situation in these markets. So really have to, I think the key learning from my perspective is that you have to find customized solutions catering to each of these markets. You have to really work closely with your internal and external stakeholders, understanding the nuances in each of these countries, and then build bespoke solutions, incorporating the regulatory restrictions, the tax considerations, the operating and regulatory reporting requirements. So all those have to be factored in, and then come up with a solution which works for you. There's no, again, off-the-shelf solution which is available, which you can apply to your organization in each of these countries.
And of course,
the other, yeah.
So I was going to say, the great thing is that each country is different. So, but which are the countries which you really can't manage, or which are the ones which you can do, but they tend to be burdensome from a documentation point of view?
So I think the countries like Thailand, Indonesia, Malaysia, these are doable, but again, comes up with really a ton of reporting requirements, ton of manual work which needs to be built in as part of the process. And that's what I think, if you're talking about automation, I think that's where I probably go into. If you try to manage all of these nuances and try to manage these checks and controls which you need to put in place for these solutions at your end manually, it becomes really cumbersome. And that's where technology automation comes in handy. If you can set up a rule-based solutions and then come up with automated regulatory reporting requirements, something like workflow solutions, where I think and David was talking about, try to make those solutions as efficient as possible, reduce those manual touch points from our side. I think that's the objective which we look at in these countries where the intercompany loans are feasible but manual and cumbersome. The other countries where the intercompany loans are not possible are, for example, Vietnam. We talked about Philippines as well. For extraction, it really becomes really difficult to put in intercompany loans in these countries, or it's next to impossible actually. So there you need to find alternative ways like dividend, or you might need to find alternative ways like improving your import payment process or other credit terms evaluation, which you need to look at.
Okay, so you say Vietnam and the Philippines, you just can't do intercompany loans, is that correct?
Correct.
Or is it a case where you can do it, but you need prior approval from the central bank, and that comes with strings attached?
So I think Vietnam, you can't. Philippines, you have to. I'm talking about from extraction perspective. So Philippines, you can do, but you have to get central bank approval.
Okay, and that can be quite challenging. And I believe you have an interesting situation in Korea that you've worked on with David. Is that correct?
Yes. So Korea is another interesting market for us. Again, with very nuanced regulatory landscape, which needs to be dealt in, whether you create an onshore structure or a cross-border structure. I think our objective, again, as I said, I talked about the phased approach, where you can actually, where you first focus on the funding structure, making the local leadership really comfortable about what you plan to do, and then talk about the extraction model. I think from our perspective, we actually took a phased approach in Korea. Our first objective was to make sure that we have an onshore funding structure, need-based solution to basically cater to the entity's funding requirement as and when they need the funding, and to mitigate that liquidity funding risk from our side, and then work on the extraction solution. And when you work on the extraction solutions, of course, the central bank regulations come into picture, and then you have those local banking landscape also, which comes into picture as well, because we have a few local banking relationships where a bank account or cash is basically scattered. So how do you plug them into the overall consolidation model and then take it to your regional or a global consolidation hub? And that is something which I think is another level of discussion and other level of complication from Korea perspective. But I think our first objective was to make sure that we have a good, robust funding structure in place for Korea.
Okay, so you've got a good funding structure in place, and that's enabled you to take more cash out on intercompany loans, because intercompany loans, I believe in Korea, they're possible, even though there is some administration again, right?
Correct. And I'll be honest about it. We only have funding structures from our perspective right now. We are working on creating an extraction structure. But again, we took a phased approach in this one. We're really focused on funding structure first, and then moving on to the extraction.
Can you work with?
But yes, it is possible, and something which we are working.
And you work with Deutsche in terms of centralizing the cash within the country first, right?
That's what the solution we are exploring right now.
That's the work. Okay, that's the one you're working on. Okay, so again, I think but the important message for everybody here is that it's a great help if you can start by centralizing the cash in the country. Okay. So if you can put all the cash in one place, and then you have one intercompany loan and all the hassle that goes with it, as opposed to intercompany loans with each local entity. And that, you know, and as we know, within Asia, there are some countries where the internal pooling isn't easy to do either. So, Andrea, what about you and intercompany loans? Are they a tool that you use a lot?
It's a tool that we use a lot in some countries, some jurisdictions, but not others. So we mentioned some of them now, where in order to put in place an intercompany loan, you have to respect some strict rules in terms of quota, tenor, fund usage, and also percentage of equity that we can extract from the country. So, you know, it's an instrument, it's a tool that should be really carefully adapted to the legislation that is different from one country to the other. What I wanted to underline here is, as you mentioned, we are forced to work or to centralize the cash in some of the regions and some of the countries around the world. So I think we need to discuss about the bank partners that we involve in these countries. So it's really important that we develop a good relationship with our banking partner in these specific jurisdictions, because they are requested to advise us on how to extract the cash, how to handle the instability that we see every day now going on in different countries in the world. And at the same time, we have to differentiate our risk. To me, what we have noticed in the last, I would say, couple of years is that concentration risk is becoming more and more important. Let me explain what I mean. So, of course, the rating of all the banks is important for us to decide how to place our business. But at the same time, the recent crisis of the Silicon Valley Bank, of Credit Suisse as well, show that every bank is like any other corporate, can go into bankruptcy, regardless of what is their credit standing. So for me, the concentration risk is important, and that's why we are changing our treasury policies in order to spread our risk more widely across the different banks. So despite the credit standing is important, for me, even if you leave all your cash with a AAA rated bank, you are not safe, you're not secure. Every bank can go into trouble if all the deposits are withdrawn from one day to the other, using these electronic ways that we have to access our cash. So we need to be extremely careful on how we allocate business. So coming back to what you mentioned, Damien, the topic today is to discuss cash repatriation, but the banking partner is important as well, is behind this cash repatriation. So it's important to have a good relationship with the bank that we have in the country that is subject to cash repatriation, but it's also important to spread our risk across different banking institutions. Back to you.
Oh, no, thank you, Andrea. And that's great, because that was the question that I wanted to ask Amit about funding, and also very interested to get David's input, but we'll start with you. Because traditionally MNCs have generally preferred to work with global relationship banks and have tended to de-emphasize the use of local banks. Now, when you look at a lot of these countries, the international banks are generally not the most willing or cheapest lenders there are around. So does this, taking into account what you said, also taking into account Amit's point about making sure you have local funding available, does this mean maybe a move away from, maybe a move towards more local banking partners, which brings with it a whole series of challenges, because usually those banking partners will not just want to do or provide standby lending facilities, they will want all sorts of other things. And then, David, how does that lead into how an international bank behaves? So just start off with you, Andrea. Does this mean that you are now becoming more open to working with local banks, and how does that affect your relationship with the international ones?
No, I want to use as much as possible our international banks, but there are some countries where we are forced to work also with local banks. So there are some countries where, for example, you cannot pay salaries or taxes unless you use a local bank. So for us, for us as a treasurer, it's important. It is important to build a good relationship also with the local banks. So we cannot say, you know, there's only one size fits all for what concerns the bank. It's important that we use also, you know, the local banks where we are forced to do it, but we should continue to see the overall picture and spread our risk. Back to you.
Thanks. Amit.
No, I think I echo with that. I think our first preference is to go with that global partner banks. And I think before that, before even going to the banks, I think we look for internal funding solutions in these countries. So that again, we don't have to rely on our banking partners. But if at all, due to certain reasons, we are not able to put in internal funding solution, then I think we kind of go externally and put in those backup funding solutions which you're referring to. And even in that category, we'll try first go to our international banks. If they don't, then I think we'll probably look for some local banks. But most of the cases, I think we get that funding solutions from the banks.
So you're not at the point yet. You're not at the point yet where you're working with local banks, because you know that could be a very worthwhile solution, but it does bring some challenges. But you're
Absolutely.
not.
Absolutely. I think we have to. So not only for our funding, but when we look at funding solutions for our customers, when we look at funding solutions for our suppliers, we do have to engage with some of the local banks or local partner banks in these countries. They definitely are much more open to lending to those rather than a multinational bank or other international banks. So in those situations, we again have to maintain that balance, with Andrea was pointing out that we have to maintain a balance. How do we maintain a fair balance in terms of what ratio goes to international bank versus local banks? But the local banks relationship comes with various challenges, I think, which we try to avoid to the extent possible.
Yes, so because typically most banks, even local banks, don't like to just lend or provide backup solutions. They will want to expand the relationship, right?
Correct,
So
absolutely. I mean, that's the first thing they look for, and that's the last thing we would like to do.
But also linked into that is that, in my mind, that brings another challenge, which is that if you're going to manage the relationship locally, then you need a local team. So
Exactly.
that has infrastructure, and then you have to manage that team. So that has infrastructure and expense implications for you. So how do you manage that issue?
That's an excellent point. So we go back to what we mentioned earlier in this webinar. So all these up and downs, I would say, these uncertainties, political uncertainties going on around the world, push us as treasurers to educate our local people, regionally located, and to build better relationships. So Amit just mentioned the local funding. So this means that, you know, in some cases we need to have a closer relationship also with our cash collection team to ask them to pay, you know, locally, okay, to some customers instead of centrally, as we used to do in the past, to explain to them what we are doing. So in the end, Damien, the cash repatriation issues is becoming not a treasury issue, but it's an issue for our CFO. So now we have quarterly calls during which we review exactly country by country what we are doing to repatriate the cash. We are driving the process, of course, as treasurers, but many other departments are involved. So up to now, we have not discussed about the tax, but there are tax implications in cash repatriations processes. Also, you know, accounting, cash collection, cash out. So it's really a company-wide topic.
Absolutely, and if I may, we can come back to that. But before that, I'd like to get David's view as a bank. How do you view this trend? If it's becoming a trend, is it a threat or an opportunity?
I guess from the engagements we see from corporates, it's similar to what's already been voiced. The preference is to go with one of a select number of global partners. It simplifies the structure, and as clients look to rationalize their, partners and account structures, that makes things a lot easier. From a Deutsche Bank point of view, our job is to ensure that we've got the right services in the right places, but we're not everywhere. So it's only natural that clients will look to, choose a number of partners to serve their needs. So I would say just in general, simplicity is where treasurers are looking as they centralize more activity, and a collection of global banks can provide that based on the various geographies.
Okay, sorry, I was just checking because I think we've got a question that's come in. I'll come back to that. But is this an opportunity for banks like your own to maybe partner with local banks to kind of provide a seamless interface?
Well, and we do. So, a number of markets, the Philippines is a good example where we don't have the branch network. And depending on what the services are that are needed, we partner to deliver that last mile connectivity. But as the world becomes more digital and you start removing mechanics such as checks, then some of these processes aren't necessarily needed in certain markets. So, I go back to the point I made earlier, really, which is if we're in a market and we've made a decision to be in that market, we want to obviously provide the full set of services to the client. But Deutsche Bank has made a decision, as are for other banks, that they're only going to play in certain regions or sub-regions and not be in every market everywhere in the world.
Okay, thanks. Now, just reading through the questions, and so thank you, they're beginning to come in, and please continue to send them. But there's one for you, Andrea, which is talking about concentration risk. That's great and understand, but then how does this work with your transaction banking? Because usually you want your cash management processes to be with as few banks as possible. So is there a contradiction there?
Well, first of all, in terms of policies, now we are going towards imposing a maximum business that we can give to any bank. So there is a percentage that we allocate because of the concentration risk. So not only we should take into account the creditworthiness of a bank, but also the maximum business that we can give to them. At the same time, and that's a way to save, to safeguard all our cash. At the same time, we have some banking partners that ask, of course, to get business in return for participating to our committed lines, to our loans, and so on. So that's an open discussion that we have with our banks. So it means understanding where our banks are strong in offering services and to give them some business in exchange. It's not easy because it means really to have an open conversation with each other. So in the end, we deal with more than 100 banks across the world, but we have around 10 core banks, which are our main banks across the world, with which we have this discussion about the business that we can give to them. But from a policy point of view, I really think we have reached a point where we have to be extremely careful on differentiating the risk across the banking partners that we have.
Okay, thanks, I understand, but at the same time, the more cash management solutions you have, the more challenging life becomes. I mean, how about yourself on this one?
No, I think the banking strategy is pretty much the same, I think, which Andrea elaborated. We have a set of banks which is designated as global partner banks, which in line with our credit facilities which have been provided to us. And we try to ensure, again, not to over-rely on one bank or few set of banks. I think try to ensure that we are diversified in terms of the region countries. Even from region perspective, I think we try to minimize the dependence on certain bank. Although on the other side of the things, if you look at it from cash management perspective, you would want to partner with one bank only so that you can automatically channelize those funds across geographies, across countries. And if you have different banks, then the multi-bank arrangement comes into picture, and then which makes it really tough to consolidate cash across those banks. So it's a very important trade-off from a treasury perspective, and that's where I say, right, it's a very important decision to keep a blend. How do you want to diversify the risk and at the same time maximize the concentration of cash as well?
So no easy answer. David, as you're on the other side of this, how do you view this question?
I think it's the same as I mentioned earlier. Really, our job is obviously fully respect that the concentration risk is something that no business is going to have full concentration risk with any single partner. So completely logical. From a bank perspective, it's about making sure where we've made a decision to provide services that we're able to give a full solution to the client in that market. So that's where our focus is in the markets that we've committed to be in.
Okay. Now, thanks. We're running out of time, and the other question that we've received talks about a country we haven't mentioned yet, and that, of course, is China. I never thought I'd say this, but the reason is because it's relatively easy to work with compared to what we're talking about. But yeah, I mean, how do you, you haven't mentioned China yet? Is it because everything works and is easy?
And I would say yes, to an extent, because we have good structures put in place for China. But of course, those are not fully automated. I think there have been few improvements in terms of moving from manual to semi-automated structures. But in terms of improving the efficiency of the structures, there is definitely potential. But the structure does exist, and we have been able to take cash out, and the government allows us to do that through, of course, within the prescribed mechanisms. But that's something which is, again, it's something working as of now.
Easy is a relative term, of course. Andrea, what about yourself?
Well, for China, we are putting in place a dividend repayments, but the interesting thing is that we are discussing with our banking partners various ways to extract the cash from China. One of them could be to set up a legal entity in a free trade zone areas, but of course there are always some requirements to meet. And the intercompany is also another alternative which should be really very closely assessed. So for me, China is very, very similar to India for what we've mentioned earlier. But it's another opportunity for us to reinforce our relationship with our local bank and with our local people. Because up to yesterday, for example, we didn't have a point of contact in China. Now we are forced to have. So it means, again, educating someone locally to speak to our local bank, because you need to be fluent in Chinese and to understand all these regulation in place, all the local regulations in place to respect all of them. So for me, compliance is a zero tolerance game. So we have to adapt all over the world to all the regulations in the world. Having a centralized treasury, of course, doesn't mean that we can be expert in all the countries in the world. Sometimes we need to rely on local people. We need to develop a relationship with them, and they can be our partner in the day-to-day activity. And China is one of those countries.
So I think this brings us back to the previous discussion, which is maybe the highly centralized model is going to be challenged as we go forward. And if I may, China, I think we would all agree, by the way, it is possible to do automated cash sweeping out of China and cash pooling. But there's always the challenge of understanding the regulations, because that is an ongoing task. They keep changing, and it depends on who you talk to anyway. So yes, I think to go back to the person who asked the question, China works. It does require a lot of effort, but it does actually work. Would that be a fair summary? And David, again, obviously, China is an extremely important market for all the banks. how does...
Yeah, so I mean, just to pick up on some of the points I made earlier, so there's the single trade window now, so that's starting to simplify the digitalization of documentation. There's the cross-border RMB scheme, so you've got to obviously apply for that. The bank, Deutsche Bank's there and other banks to guide you through that process to get that approval, and there's a lot of conditions around that. And then moving the liquidity out and what you do with the RMB. And one of the things that's interesting, which I'm sure people on this call are aware of, is the basis difference between the onshore and the offshore curve for RMB. So that can actually generate some economic benefit for clients, as the default tends to be to move it into offshore and execute in the CNH market, and that's not necessarily the best outcome. So certainly in my area, what we do is we look to automate that so that based on the client's preferences, you execute against the most beneficial curve for the client. But obviously clients can manually manage that themselves if they choose to. If you execute on the onshore curve, you need to provide underlying documents, which you don't on the RMB offshore curve. So I think that's an area that is underutilized, I see, with corporate treasurers at the minute.
So we're running out of time, so I'd like to say thank you to the three of you. I personally have found that fascinating and very enlightening. I hope the people on the call did, and really appreciate the input. I think there's one clear message coming out of this, which is nothing changes, or everything is changing all the time. The one thing that doesn't change is that treasurers need to be on their guard and looking out at things. So Marielle, with that, I'll hand it back to you.
Thank you very much, Damien. Before we go, I'd like to say a few thanks and give you some information on the upcoming activities. So please let me first thank Damien for chairing this session, and David, Amit, and Andrea for sharing their experience and best practice in this very complex topic. I would also like to thank Deutsche Bank for making this event possible. And finally, thank you all for being here. I hope you found the session helpful. Please feel free to continue this conversation with the speakers and colleagues at the Global Treasury Leaders community. You can join using the link I shared with you earlier on the chat. We're going to, through a platform, we can put that link again, Kendall, please, so you can exchange experiences and ask questions to all the members of that community, and we share content on a regular basis. The next webinar will be on in-house banks, again, very topical in the current environment. So please watch out for our emails. We will be sharing more information shortly. I hope to see you then, and thank you very much all again. Goodbye.
Thank you.
Thank you. Bye.
Bye. Thank you. Bye.
Bye.